Welcome back to the Central Arizona VITA Network's presentation of 2021 VITA tax law training. In this session, we're going to begin by reviewing some test-taking strategies in the publication 6744. By now, you should have had a chance to review that booklet, and we're going to show you some strategies on test-taking skills. Then we're going to continue on with our discussion of taxable income. As I said, we're going to start off today with going over the test booklet and make sure you know how to go find the resources you need to be able to answer these questions. Okay, so you should be able to see my screen, and there's the 6744 test booklet. And over here, I have the table of contents expanded. See how you can expand that there, clicking on that button. And here, I'm going to show you here. Here's the table of contents that it goes down. You guys have already taken the volunteer standards of conduct and the intake and interview. So I'm going to go, here's the advanced course scenarios and questions. If I click on that little plus, I can go through each scenario. And we're going to start here with scenario 1. And what we want to do is kind of use this as a review of what we kind of talked about yesterday, and then talk about strategies of how to take these tests. So here it gives you some fact patterns. And by the way, you know, as you go through these, just try to answer the ones that we have covered. Okay, don't try to, you know, if you come across something, oh, we haven't talked about itemized deductions, just skip it. Okay, but try to be working on these over the next few days, so that as we get towards the end of the week, you're ready to take the advanced test. So as I look at scenario 1, it gives you a bunch of facts. So right here, it says Karen's husband, Fred, moved out of their family home in April of 2021. Big flag goes up right there. Oh, they're not living together. But then it says she has not heard from him since. Okay, so he abandoned her. But it then says they're not legally separated. Those are all facts you need to kind of keep in mind here. Then it says Karen's got 2 children. It says how old she is. It gives you some income, and she made some contributions to Red Cross. She paid all the costs to keep up her home. See, that should clue you in there, because remember, what are the requirements for claiming dependents, right? That was one of them, about you had to provide more than half of their support, right? Then it says she got an economic impact payment, and that they're all citizens. So now let's look at the questions. So it says, what is the most beneficial filing status that Karen is eligible to claim on her 2021 tax return? And here's what I would say. Don't jump to conclusions on this, okay? Especially until you get more experienced or advanced at it. I would first of all, and I'm going to pull it up right now. I think I'm going to pull it up. Hold on. Yeah, here we go. I got to do it a different way. I'm going to pull up the 4012. And we showed you about those flow charts. And right over here in the table of contents, it says right here, tab B, starting a return and filing status. And then there were these aids. And here was the two tables we talked about, the filing status interview tips. I had to go back up one here, right? I like this decision tree, this flow chart right here. And you start doing, were you married on the last day of the year? Okay, was she married? You should, it tells you right there that she was abandoned. So be sure to look at these notes right here, okay? It was 1 and 5, and you know, so this 1-5 is talking about whether your spouse was a non-resident alien, and so that none of those apply to us, right? But the answer here is yes, she was married. So then you follow the tree down here, and you get down to this one right here. Did you and your spouse live apart all of the last 6 months of the year? Okay, and the answer is yes. And then you're going to go down here and you're going to look at this. Do all of the following apply? So, and I'm going to let you kind of read those, but that's going to give you the answer to this question right there. Right there, if you go through that, you're going to have the answer to this question. So that was this. Now, what I want to show you right here is this was the regular test question. And I'm going to scroll down here and look at advanced scenario. Right down here at the bottom, it says the course retest questions. And when I click there, we see advanced scenario 1, and it's the exact same fact pattern. Nothing changes. But here, and then question 1 is still about her filing status, but now it's a true false. Sometime I'm hoping you'll go in and answer both the test and retest questions for 2 reasons. 1, sometimes you find the answer in the retest or the test for the other side. And then 2, if you answer both of these, IRS, when you go to take these certification tests, they're not going to come up with new questions on you. They're either going to pull it from the test or the retest. And if you answer both of them, then when you go to take the test, you just got to go look in your book and see what you answered. And don't rethink it. Rethink it now while you're doing it, while you're answering it. But once you've answered it, don't sit there and get confused by reading it again, right? Just go with what you did all the work and you did all the research. You answered it. When you go take the test, just circle the answers and be done with it. Okay. Then we get Barbara's 57. Oh, okay. This one's a hard one. This is one of the harder ones. And you've really got to use the resources in the 4012 for this one. And we have covered some of these things. So it's saying Barbara's 57, was widowed in 2021. She owns her own home, provided all the cost of keeping up the home for the entire year. And her only income was $36,000 in wages. Then we have Jenny, age 24, and her daughter, Marie, age 3, move in with her mother, Barbara. So we got grandma, daughter, and granddaughter, right? We got 3 people in this house now. And now it says Barbara separated from her spouse in April of 2021. Again, that's an important fact. So, because when we start looking about who the dependent is, what's the daughter's name? Marie. Who is she the dependent of? This is where it gets kind of tricky, right?
Sorry,
and then, yes, Deborah.
The question that's confused me straight off. Does it mean Barbara separated from her spouse, or does it mean Jenny separated from her spouse?
Oh, okay, that's a good question. Okay, so, and that's what I'm saying. You got in your mind and keep who the characters are in this play, right? So Barbara is the grandma, Jenny is the daughter, and Marie is the granddaughter. Marie's the child of Jenny. Jenny is the child of Barbara.
Yeah, but it says Barbara was widowed in 2021, and then it says she separated in 2021.
Okay, I didn't quite understand. I heard that Barbara was widowed in 2021. Then what was it you said?
And then it says Barbara separated from her spouse in April of 2021.
No, I think what it's saying is you got to read the whole sentence. Let's read this whole sentence.
Jenny that separated. Okay, thank you.
Yeah, right. It says she moved in with her mother, Barbara, after she, and hey, Deborah, I got to tell you, that's a bad sentence. Usually when we have a pronoun right there, it refers to the person directly before it, right? So I can understand why you would confuse that. You know, if I was writing this sentence, I would have said after Jenny separated from her spouse.
Thank you.
Yeah, so it's good, very good question. Thank you. So now we get down here. For purposes of determined dependency, Marie meets the conditions to be the qualifying child of who? Is it Barbara, Jenny? Is it both Barbara and Jenny? And the only way you can find that out is in this one, you've got to really read through the 4012 carefully. And I'm going to in a minute, Jean's going to start directing you to it, but I really want to kind of direct you to this one here. There was tab B, return and filing status. But what we want to do is go look at tab C, dependents. And because what this question is asking is, who are they the qualifying child of? So you need to really go look at all of these right here. These are the tests for them. Then you go into the next one. And is it possible they're the qualifying child of more than one person? So you've got to kind of look at this and read through this to be able to solve this problem. Okay. So I'm going to leave that to you. I just wanted to point you to where you've got to go to be able to find that answers. And then now it says, Jenny is not eligible to claim Marie for the earned income credit. Oh, stop. We haven't talked about earned income credit. We'll come back to that. Okay. So now we get into the advanced scenarios 7, 8, and 9. And this tells you up here, using the tax software, complete the tax return from including Form 1040 and all appropriate forms, and answer the following questions following the scenario. And so what I'm going to suggest, some of these questions, you know, you may look at them and say, well, hey, I don't need to finish the tax return. I can answer this. I'm going to suggest to you, just finish the tax return. It'll just be easier for you. Okay. And because the tax software is going to calculate, like it's going to ask you, what was their withholding? Well, if you do the tax return, you can find it right there on page 2, total withheld. Okay. Without going through all of the forms and doing it. So this goes on and it tells you when so you're going to do these in practice lab. So hopefully you have all been able to create the practice lab accounts, and you should start creating these returns. And here's where you're going to get the information we kind of showed you about, where, you know, to give you the social security card numbers with those X's, just put in any 4 digits of your choice. Then it gives you facts down here about this whole scenario. Really important to read these very carefully. You know, I'll tell you, one of the ones I missed was up above. It was up above in one of the scenarios. And I just assumed, oh, well, she's lived apart from her husband. She's married, filing separate. And, you know, we're going to find out later on that for the earned income credit, you can't claim the earned income credit if you file a married filing separate return. And what I did, I just jumped to the conclusion without reading all the fine print and I missed it. So the point I'm trying to say is read these things carefully, right? That you're doing. So then down here, so it gives you the social security numbers so you can start the return. It gives you the intake and interview quality review sheet. So, because you can't even get started on the return till you answer things like, what's their date of birth? What's their occupation? So this is where you get all that information to do it. Then on down, they start giving you the tax forms, like here's the W-2. Now, we covered this yesterday, so you should be able to go into Tax Lab, excuse me, and input the W-2. Here we have a distribution from a retirement plan. And I'm going to give you a little clue. One of the harder parts of this test is this 1099-R right here, because right in here, you're going to see this saying total employee contributions. That gives you a clue right there. And especially when they don't say what the taxable amount is here, that gives you a clue. And we're going to cover this today, but I'm just kind of giving you a heads up to pay close attention to this one. That gives you a clue that not all of his distribution is taxable, because this is an annuity, and there's nothing that really, well, it does tell you up in the fact pattern that he started getting this annuity. And it gives you the information you're going to need later on. And then, oh, here's a social security statement. While we're on here, sometimes it'll say benefits paid in 2021. Ignore that. We want to use what's box 5, net benefits, because sometimes those numbers are different. But we always want to put in what's in box 5 here. Okay. There's also other information here that we use that you're going to want to put in, like what was his Medicare Part B premiums. These are insurance premiums. And when you get onto that screen, it's going to tell you where it's going to ask you what was his Medicare Part B premiums, because we're going to find out later on today that maybe that's an itemized deduction. I say maybe because most of our folks are not claiming itemized deductions. But just in case, if you key it, see it. This is one of those things that you're going to want to key. What else have we got here? Oh, cancellation of debt. Now Jennifer and I kind of got into a big kind of discussion of this, but the general rule you want to do, you want to say, remember, income is everything that makes you better off unless it's specifically excluded. And I'm going to tell you right now, cancellation of debt is not excluded. Okay, so we're going to go in and we're going to put in this income here. Then here we have gambling winnings. And remember, there's no exclusion for gambling winnings. We did say, and I think Beth had asked, well, can't you deduct your losses? And I said, yes, up to the amount of your winnings, but only if you itemize deductions. If the standard deduction is bigger than the itemized deductions, you can't deduct the losses. So it depends. You know, if they've got, you know, I kid you not, I have seen people come in. I had one person come in that they had this W-2G and it had $60,000 of winnings. And then the guy told me, but hey, we've got documented losses way above that, right? And he did, and the casino prints out those things for you, you know, or you can keep them in a spreadsheet. And so right away, you're going to know we're going to itemize deductions for that guy because he's got 68,000 in losses. And if we don't itemize deductions, he's going to have to claim 60,000 in winnings, right? So there's that. Oh, and here now we have a tuition statement. We're going to talk in just a minute. I'm going to start picking up where we left off and talk about these things. And then here's their statement of account for Gordon College. I'm going to tell you in a minute that this is really important. We get these statements of accounts because it gives you more information than that 1098-T does. Okay, so that was here. Now here's the questions, and I'm going to start kind of going quickly so we don't get behind today. But it's asking, what is the taxable amount portion of Tara's pension? There is no way you can answer this until you do the tax return, okay? It's going to say none of Tara's Social Security income is taxable. Well, remember, we did talk about income, and I did say that if you don't have much other income, you're not going to pay tax on your Social Security. But I said it's a complicated formula, and in this case, it's complicated. You have to do the tax return to really be able to answer this question, okay? How much total of other income? And some of you may say, well, I don't need to do the tax return to answer this. I can just go look at their forms. I'm going to warn you here, it's just easier to do the tax return, okay? Here, there's one about an adjustment to income, which we haven't covered, so don't worry about that. Here, the Washington standard deduction on their tax return is, and yes, you could probably answer this just based on the facts and that. I'm going to tell you, just do the tax return and let the tax software answer it for you, because there's a little trick on this one because it has to do with their ages. I'll tell you that right away. Okay, so you get the idea. So like, here's another one. And I've had students say, well, hey, I don't need to do the tax return to do this. I can go look at the forms of what their withholding was. And yes, that's true, but it's just easier. You need to get the tax return done. Okay, so I think I've emphasized that. I'm not going to go over these other scenarios. Just go in and put in, as we go, put in what you can for the tax returns. We're going to go over more in depth tomorrow after we've covered income and deductions and adjustments today.
Jim?
Yes.
This is Nancy.
Hi.
We got a tax alert, I think it was at least a week ago, and at advanced scenario 8, Cynthia Simon, there is something they've added to the booklet. So I don't know if you have a copy of that you could tell people, but yes, I received it. Is it Rhea? I think she sent it out.
Yes. And yes, I'm going to talk about that. In fact, Thank you for reminding me, because I do want to say, first of all, what Nancy is referring to is we get what are called volunteer tax alerts all through the tax season. And we as site coordinators, we have to make sure our volunteers get them. And as Nancy has said, she's already signed up as a volunteer and she's received it. And then we also have to have printed copies at the site when you come into work. if we get audited by IRS as a site, they're going to want to see those volunteer tax alerts. This one that Nancy's referring to says ignore the amount of self-employment income for that. But and for right now, it has to do with self-employed health insurance. It's really, most of you would not have even picked up on what this is alert. There's some more advanced preparers that'll say, hey, I can claim self-employed health insurance on this, and they're correct. But what the volunteer tax alert is saying, hey, for this test, just ignore it. Okay. I don't think many of you would pick up on the idea that we could take a self-employed health insurance deduction on this. However, that being said, and right now, if you have your books, get them out or take a note about this, because this is an important one. And this is the other one I missed right here. And I'm going to tell you to change some wording. This didn't come in a volunteer tax alert, but look at this wording on here. And I got to find it here. Yeah. It says here, Cynthia took an early distribution from her IRA in April to pay off her educational expenses. And then it tells you Cynthia is paying off her student loan from 2018. Right there. Now, we haven't really covered this yet, but we're going to talk about IRA distributions later on today. Okay. I'm going to ask you right now to change two words. Okay. That off right there, and that Cynthia took an early distribution from her IRA to pay off her educational, change that off to on, to pay on, to no, or just strike the off. She took an early distribution from her IRA to pay her educational expenses, because up here it's going to tell you she's in an MBA program somewhere in here. Hold on. Oh, right there. Cynthia is working on her master's of business degree. When I read this, I thought it said she took an early distribution to pay off her loans. This is to pay, I said pay on her educational expenses, okay? And then change this off to Cynthia is paying on her student loan. She hasn't paid off her student loan. It's still going. But what this is telling you, and you're going to learn about this in just a few minutes when we talk about adjustments, down here, it shows you, hold on. It shows you, I'm almost there, hold on. Student loan interest. See, this is telling she's paying on her student loan. She hasn't paid it off yet. So that's why I want you to change those two words. I misread that. I thought she took an IRA distribution to pay off her student loan. And we're going to find earlier, we're going to find in a little bit, or actually it's going to be tomorrow, we find out about exceptions to paying a 10% penalty when you take an early distribution on your IRA. So Nancy, thank you for bringing that up to my attention. I meant to tell everybody that. Okay, so there's for our review. And right now, I'd like to start bringing back up, hold on a second here. I'm going to bring up our, where we left off yesterday. You guys, this is where we left off. And the reason I left off, and give me 1 second here, I got to take out my tea bag here. The reason we left off right here is because this is one of these areas here. I'm going to tell you what I like to refer to. What I'm going to discuss here in a second is the one tax loophole that we get for poorer people. You know, it's mostly the rich people who get the tax loopholes. Well, I'm going to describe one here in a minute. Okay, so here, when you see a tuition statement that looks like this, you get this 1098T. That's right here. And it shows here are payments received for qualified tuition and related expenses, $4,000. But then it says the institution, they got $6,790 in grants, scholarships or grants. Now, if I take you back to that income, what is income? Remember, I took you to the chart that said what is not taxable income. And one of those things I pointed out was if you get a scholarship that is used to pay for qualified expenses, and by the way, this tuition and related expenses, these are qualified expenses. If you use the scholarship to pay for these expenses, then the scholarship isn't taxable. But hey, look what happened here. They got more scholarship than they have qualified expenses, at least by this form. So the result is we have to put in $2,970 as unearned income. And this is something you're going to have to calculate. First of all, you want to ask the taxpayer, well, the college here says you had $4,000 of expenses, but did you have to go buy any books or supplies that were required? Maybe they've got another $1,000 of expenses. Okay, there's one thing we need to be sure to ask, and we're going to cover that when we get to credits. And then the second thing we need to think about is when we get to credits, and educational credits can be a big, there's like $2,500 they could be getting back for this. So it's a big deal.
Can I point out that the example says 6970, so it's actually 6790.
Okay.
So we just gave them more taxable earned
Right.
income.
Okay. And very good, Jennifer. Good eye. We'll correct that in the next slide. Gene warned you, right? When we do these things, and I'm going to warn you, there's always mistakes. And there's a good one. We just did a little dyslexic thing, either Gene or I forget who did this, but, and this happens on tax returns a lot. This is why we do quality review. So Jennifer was just our quality reviewer there. So thank you. But the concept is what's important here, is that you have to take their scholarships and grants and then subtract. If we use that money to pay for qualified educational expenses, we don't have to pay taxes on it. But if we use it for other things such as room and board or things that aren't required for the class, we hire a tutor or something like that with that money, we have to pay tax on it. And we're going to show you, I gave you the teaser about the loophole, is sometimes we're going to say, hey, now, if we don't pay tax on that scholarship, we cannot use those expenses to get the education credits. However, sometimes it's better to say, hey, let's just go ahead and pay tax on all of it, and then we can use that money to claim the credits. So I'm planting the seed in your mind right now, okay? That's the loophole I was referring to. So let's go on here. Here is the input screen from the tax layer. And here where it's going to tell you that you have to do that calculation, and we're going to get Jennifer to do the calculations because she picked up that we did it wrong, right? But you have to take the scholarship minus the amount you are using for qualified expenses. And then the balance you have to put in here because now it's going to show up on the tax return as other income. Remember a moment ago, I told you that don't just go use the forms to answer those questions when it tells you to do the tax return, because we're going to find out in that tax return that maybe not all of it is other income. So this is where this is step by step of how you access where you're going to put in that 1090T. You click on the federal section, then on the income menu, then you scroll all the way to the bottom and there's a place that says other income, and you click on begin. Then there's another one that says other compensation. You click on it to begin. Then there's scholarships and grants. See, it's kind of buried in that thing, and we'll show you a picture of it later on too. But there's where you're going to enter the excess. Okay. So here's kind of a question to take you back to this income stuff right here that says, which of the following sources of income are not reported? And actually, well, yeah, it's on line 8 of Schedule 1. But it really doesn't matter where it's reported. The point of this is saying, what might not be other income? It is important in this one to say where it's reported, and I don't expect you to know this, right? Most other income is reported on line 8 of Schedule 1, but unemployment, if you go look at the tax return, it has its own separate line on page 1, and unemployment compensation gets reported there. I didn't really expect you to know the answer to that. The reason we say this is, remember a moment or yesterday I told you, as you start putting in these practice returns, and even when you get in real life, as you're inputting stuff, try to imagine, what is the tax return going to look like when I get done? Because here, if I put in unemployment compensation, I get all done with the return and I look at the tax return and I don't see anything on that line under unemployment compensation. I'm gonna say, hey, I better go check my input. Maybe I missed something and it didn't, the tax software didn't count the unemployment. Or remember I told you in 2020 was the 1 year that up to 10,200 was excludable. And if you happen to be doing a 2020 return, which is not likely in your first year, but you know, there's one place where if I didn't see it come through, I want to look and say, oh yeah, that's 2020. They didn't tax it that year, right? So that's the point I'm trying to kind of get to you here. So let's keep going with all of this. Medicaid waiver payment. I'm not going to spend much time. We included this last year because there was a test question. This is so rare. I have never seen one of these other than on the test, and it's not on this year's test. But there's an opportunity sometimes where you get these Medicare waiver payments. Sometimes they're not taxable, but you can elect to have them taxable because it could help your earned income credit. And so this is saying the taxpayer may choose to include this to help them with these credits. I personally, I have never seen a Medicare waiver payment. So I'm going to tell you, here's what I'm going to tell you. If you come across a Medicare waiver payment, get your site coordinator involved because they're going to probably remember, oh, I better go read up on this. Okay. Or you can read up on it. Okay. And here's where it kind of shows up. Other than that, I'm going to tell you, just don't even worry about these, right? So, and here's in tax layer, there's a screenshot where you can put in that medical waiver, and there's a little box you're going to check if you did want to include Medicare waiver payments in the calculation of earned income. So we've covered salaries and tips and business income. Are there any questions? We're going to go for about another 45 minutes before we take a break. Okay. And then we want you to be able to look in the Pub 4012 for where you're going to find information to answer those questions. You know what? I'm going to pause for just a second here too, because we keep talking about resources to answer those questions. And there's one other resource that I haven't talked about, and you all are going to say, well, hey, I'm just going to Google that. Right? And you know what? There's nothing wrong with that. Nothing wrong with that at all. Okay. But watch the source. You know, so if I just pulled up a browser right here that you can see, and if I put in Medicare waiver payments taxable. I'm not sure what I'm going to get here. I haven't tried it. But so I Google stuff. Google is certainly a good resource to do, but watch where you're getting it. So first, right off, it gives me irs.gov. Hey, that's a great source. You know, it's reliable, but it's hard to understand. I kind of like to go look for, so here's another, oh, see this VTA? There was a volunteer tax alert last year about this, right? That's what that. And then here's one that comes from Medicare waiver payments. Are they taxable? Now this comes from intuit.com. I tend to read the intuit.com, H&R Block. Those sources are fairly reliable. They're big companies and they don't usually put stuff out if they haven't kind of double checked themselves. And I will tell you, they're easier to read. Okay, so no reason not to go look at that. But here's what I do is I go kind of look at their answer, and then I'll usually go back and I'll look at the irs.gov site and try to see, can I confirm what they said, right? And here we have questions and answers, and we won't go through that. So the point that I'm trying to make is, yeah, Google is a good way to find quick information, but be careful. If I go back into these things, I bet you I can come down here, and if I look hard enough, I bet you I can find some things like, okay, here's from LatinoTaxPro.com blogs, right? Now, I'm not saying that that's wrong, but you know, anybody can go post something to a blog, and maybe they just don't want to pay tax on that. You know, I'd beware of those sources. You know, go to the reliable sources. That's all I wanted to kind of tell you about that. Okay, so we're going to start into session 3, and here's where we're going to start talking about retirement income and capital gains, and then later on adjustments to income. And I'm going to get started on this until we take a break, and then Jean's going to take over from me. So kind of give you a break from my voice a little bit. So here we go. Whoops. Uh-oh. Sorry, hold on, you guys. I got to open up session 3. Give me a second here. I'm going to get to it really quick. Here, if I can go up here, quick access. VITA training session 3. There we go. So this is something that is Jean put this in here, and this is based on very good educational research about how you really learn stuff. And you know, there's these passive teaching methods, which is kind of what we're doing. How do people retain stuff? And you know, if they just sit there and listen to me talking about it, they're not going to retain very much, right? If they read about it, they're going to retain a little bit more. If they see something like we're doing this PowerPoint, we're encouraging you to read, we're going to do that. We're kind of demonstrating some stuff, so maybe that, but where do you really get to retain it? And it's down in this lower half of the pyramid where you're discussing among your peers. And this is a big one. You practice by doing it. I like to tell my students when I do it that, you know, a lot of my students will say, well, you know, I don't learn very well listening to, you know, you talk here. I learn by doing it. And I agree with that 100%. But I like to kind of twist this around. Okay. You learn by reading and listening and doing that. You learn the concepts, and then you get better at it by doing it. Because you're going to forget most everything you listen to or read about, you're going to forget really quickly. Once you start doing it and putting it into practice, it writes it to that long-term memory in your brain. And this is why we have you do the practice labs. There's where you really start learning it. And then when you come across a brick wall and you got to go find it and figure it out, that's what writes it to the long-term part of your memory. So we try to give you a whole lot of things. But if I was to tell you, okay, go take scenario 7 and answer all those questions, and don't tell you how to get into practice lab, don't tell you anything about inputting stuff into a tax return, don't tell you anything about what income is and what it isn't, you know, are you really going to be able to do that? No. So it takes all of these methods to really get good at something. That's my pitch to you right there. So, and then practicing without feedback is like bowling through a curtain. And I totally agree with that. You're going to do these tax returns, and even when you get on a site, you're going to do a tax return, then a quality reviewer is going to look at it, and the quality reviewer may find things, just like Jennifer just found a mistake that we did, right? It's pretty important that when you start doing quality reviews, you kind of give some feedback to the person who was doing it. So maybe it was a simple mistake, or maybe they just didn't understand something. So you want to give them feedback, and we expect that you want to get feedback from us. So ask questions too, if we don't give you enough. So here's what we're going to do today. we've already kind of gone through a homework review. We're going to start talking about retirement income and capital gains and losses, and then what are adjustments to income. Then we're briefly going to talk about Native American Arizona income, because there's some really quirks to that too. So let's jump right into income from retirement income, and it comes from a variety of sources. You're going to see it on forms. I showed you earlier in the the test booklet, where there was a 1099-R. That comes from retirement accounts. I participate. I get a pension from Arizona State Retirement System. I get a 1099-R. You're going to see a lot of those in this. I get a 1099-R. Or sometimes you took a distribution from an IRA. They're going to give you a 1099-R. I'm not on Social Security yet. I could be, but I'm waiting to let it build up a little bit. But you're going to see a lot of people come in with Social Security statements. And those are this SSA 1099. Remember also, just to kind of take you back a little bit, when our taxpayers come in, they have to show us proof of their Social Security number. And if they don't have their card, if they're old enough and they're getting Social Security, this SSA 1099 has their Social Security number, and that's valid proof. That's a government document that has their Social Security number. Then there's a few other forms. None of what I think I've seen one railroad retirement form. We do see some civil service annuities. This is where you work for the federal government and civil service, and you get a pension from the federal government. And those can be a little tricky. By the way, I would tell you, if you get one of these, it's going to show, kind of like in your assignment here in scenario 7, it's going to show employee contributions. And right away, those are really tricky. Get your site coordinator involved. We're not going to go over all the details on that. And this is the other one, civil service survivors annuity. It's kind of the same thing. We're going to focus our training on the things you see, mainly on 1099-Rs, SSA 1099s, and those. So here is the screenshot from TaxSlayer that you go into when you first go into the income screen. Then there's going to be one that says IRA and pension distributions, right? And then here's where we can do it. It also, here we're going to show you how you go in and enter a 1099-R, but this is also where you enter Social Security benefits. So here's a Social Security form. I kind of showed you that earlier when we were going through the test booklet, right? Remember, I always showed you get the amount from box 5, because it's sometimes not the same that's over here. We want this amount, right? And by the way, when you get into the TaxSlayer screen, it's going to say box 5, right? So you enter it there. But also look over here on this side, because here we're going to see that they paid some insurance premiums. Well, this says 0, but quite often you'll see that there's amounts there. And in TaxSlayer, it's going to ask you for what those amounts were. Because if, it's rare, but if they itemize deductions, they could use these insurance premiums as itemized deductions. Then always watch for federal income tax withheld. A lot of people miss that. As it says, it's the most overlooked information. As I said, now here's the TaxSlayer screen, right? That would tell you, and it's going to say, oh, okay, put what's from box 5 here. Here's their withholding amount. And here's that box I told you to put in, watch for Medicare premiums. So it's going to ask you for that. So you'll get a reminder to look at it. Generally, Social Security income is generally not taxable. But if that's the case where it's their only income. If they have other income, like I told you a minute ago, I have a pension from Arizona State Retirement System. That's other income. And I could show you the chart. It would just boggle your mind of how they figure this out. But there's, depending on the amount of your other income, there can be up from 50% to 85% of your Social Security taxable. The most it's ever going to be taxed at is 85%. You're never really going to figure that out unless you're a math wizard and you go through the worksheet. The tax software calculates that. And in one of your test questions, it says how much of their Social Security was taxable. And like I told you, the only way you're really going to be able to do that, unless you're a math genius, right, is do the tax return. And then you go look on the tax return form and it tells you, oh, here was their Social Security, here's the amount we're taxing. In my case, my wife is getting Social Security and I get a lot of other income, and we pay 85%. 85% of her Social Security is taxable. And it'll also show what she gets and then the amount that's taxable on the return. So again, that formula kind of depends on your filing status. It depends on the other income and what types of income it is too. So now let's talk about IRAs. And this is really good information for you to know. You may know it already, but it's really good information for you to know personally. Plus, we need to know this for doing tax returns. And I'm going to give you've all heard of IRAs. And there's two kind of buckets of this. There's the traditional IRAs and the Roth IRAs. And the big picture overview of this is that if you make contributions to a traditional IRA, if you meet other requirements, not always, but if you meet other requirements, you get to reduce your taxable income. You don't pay taxes on it. It's what we call pre-tax. So it reduces your taxable income. But then it builds and builds and builds in this IRA account. And then when you retire and you take a distribution from it, all of the contributions you put in plus the earnings, it's all taxable when you take it out. The other kind is a Roth IRA. And you put money into the Roth IRA, you don't get a tax deduction. So it's after tax dollars that you put into it. But here's the good thing. It grows and grows and grows. And trust me, those grow, the amount that it grows can be significant. It can be a lot. So it grows and grows and grows. And then when you take it out, none of it is taxable. Not only the amount you put in, but all the earnings and growth you get tax-free. It can be a pretty good retirement tool. Personally, I would tell you I'd like to see a mixture of both, and that way you control the income that's coming from you. Maybe as you get later in years, you control the amount that's coming out of the IRAs that you take, the traditional IRAs, and you take more out of the Roth because you don't want so much of your Social Security being taxable. That's a planning technique that you would do. Yes.
You said the Roth earnings are not taxable when you withdraw them, but the slide says they are taxable.
Okay. Okay. What this is saying, and what this slide should say, thank you for pointing that out. The earnings might be taxable when withdrawn. That's if you take it out before 59.5. So you're right. That's kind of is a typo right here, we should say, because I'm going to reiterate what I just said. What I said was accurate. You put money into a Roth, you don't get a tax deduction for it, but it grows and grows and grows. And when you take it out in retirement, none of it is taxable. However, if you take it out before 59.5, some of it might be taxable. The earnings might be. Thank you for pointing that out, Beth. I appreciate that. Thank you.
Well, I'm easily confused. So is there a maximum age that you can fund a Roth IRA?
And that's a really good question too, Beth. And where you're going to find that is in the legislative extenders of your 4012, but I'm going to answer it for you. They just changed the law, that last February Tax Act that went in, well, I confuse it. It was in these COVID acts that they did. And they changed it. It used to be that contributions to that, and Gene, jump in here and help me out. I don't know if it was at age 70.5, you couldn't, or at age 65. But once you reached that retirement age, you couldn't make contributions to a Roth or a traditional IRA. But now they said it doesn't matter how old you are, as long as you have earned income. So maybe you've gone to work at Walmart as a greeter 2 days a week and you got earned income. If you're 80 years old, you can make contributions to a Roth IRA or a traditional IRA.
You got it right. It was 65.
65. I'm 66. I'm still making money and I'm still contributing to my Roth IRAs. And I'm going to continue to do that for however long I'm making money. So, and I say making money, careful, I have to be earning money. It has to be earned income, not unearned income, to be able to do that. Good. So there's kind of the big picture. Before I leave this slide, see, it says traditional IRA distributions may be fully or partially taxable because the contributions may have been pre-tax or after tax. Because sometimes you're going to find with IRAs that people have made what's called non-deductible contributions. And when you see that, it's out of scope for us because that gets complicated figuring that one out. Okay. Oh, also, well, here's the next slide. So, difference between Roth IRA and traditional IRA. So, the taxpayers must pay a 10% penalty if they withdraw before age 59 and a half, unless an exception applies. And we're going to go over those exceptions in session 5. But remember, there's one of your test questions that asks you, hey, she took out money to pay for educational expenses. Is there an exception to that 10% penalty? Because she wasn't age 59 and a half. Now, there's a variety of exceptions. The big ones that we find are they take distributions to buy a home, first-time home purchase. And that first time is kind of loosey-goosey because it's like the first time in either 5 or 10 years. I got to look it up. But I think it's 5. So, you know, if you haven't bought a home in 5 years, you can take money out before you're 59 and a half to help you towards the down payment and not pay the 10% penalty. However, big caveat here, even though you take an early distribution from a traditional IRA and you don't have to pay the 10% penalty, you still got to pay taxes on the distribution. The traditional IRA, it went in there and you never paid tax on the money. So they're going to get that money. Now, what if it's a Roth IRA? The Roth IRA, remember I told you there's this concept, you don't pay tax twice on the same money, right? You put money in a Roth IRA, when you take that out, it could be subject to a 10% penalty if you're under 59 and a half, but the part that you take out that you have you put in without paying taxes on, that's not taxable. The earnings part, and usually I just did one of these here. I'll tell you the story in a second. The earnings are taxable if you take it out before 59 and a half. That's kind of why we put that on that slide. We should have been a little clearer about that, I think. Okay. I told you I have a client on my personal tax practice, and he did a whole Roth conversion. We'll explain that later, but he like converted 80,000 from an IRA into a Roth IRA, and he paid taxes on it. And then he went just last week and he made some IRA contributions, and he calls me up. He says, Jim, I think I just made a mistake because, I put money into my Roth IRA, and I think since I took that conversion, I'm over the income limit. And yes, he was. And I told him, call your broker and have them reverse it, have them refund that. And the broker calculated how much, that was called an excess contribution. And as long as you take it out and you pay tax on the earnings on it, he was okay. He didn't have to pay a penalty for doing that. So that was kind of an example I was kind of showing you. Here's where you see, now, by the way, you've all heard of 401ks and 403bs and all of that. Let me tell you right now, those are employer-sponsored plans. 401k is with a regular employer. 403b is if you're with a nonprofit. I had a 403B at Scottsdale Community College. For Masters of Coin, I'm an employee of Masters of Coin, and I have a 403B plan for that. Those are for nonprofits. But 401ks, 403Bs, they function like IRAs, except they have different limits. And here's where you're going to show some overlapping, and here's some differences. 401ks and 403Bs and that, they have much higher contribution limits. Okay, here's what you can contribute to the IRA. Usually it's 6,000, but it's now 7,000 if you're over age 50. That's called a catch-up contribution. So be sure when you're looking for it, if you have a client that has made contributions, I'm not sure if we have any of it in our in the scenarios or not. I don't think we do that have it, but you should just be aware for that. So as I said a moment ago, these are employer sponsors. These are your individual retirement accounts that you sign up with at a bank or a brokerage, like mine are at Vanguard, or you might be Charles Schwab, or you might be Fidelity, or some of those things. They are called trustees to it. If you're in a 401k or a 403b, this is kind of important right here. There's no income limit. So a lot of higher earning taxpayers that are employed, they tend to max out these things. They put as much in it as they can right there. But with an IRA, it's got a traditional IRA has, well, and a Roth IRA for that matter, they have income limits. If you make too much money, like the example I just explained, you can't make a contribution to it. Most of our clients don't fall into that category, though. Here's the overlap between the traditional versus a Roth IRA. And the traditional, I'm going to include that 403b and 401k too in here. And I've already explained this, but this gives you kind of a visual thing. The money you put in is tax deferred. You haven't paid any taxes on it. You pay the taxes on the money you put in plus the earnings when you withdraw it. With a Roth, the money you've put in has already been taxed. You don't pay tax on any of the money you take out, including the earnings. And it says right here, you never have to pay taxes on the earnings. I'm going to tell you one other thing that we don't have on here that's another advantage. And you heard me say I'm making contributions to my Roth IRA, and I'm going to continue to do that because, and this isn't, well, we cover it briefly later on. Once you turn, and okay, this was a new age limit. It used to be 70 and a half, but now they've raised it to 72. If you've got traditional IRAs or 401ks, the traditional tax deferred type, right? Once you turn 72 now, you have to start taking required minimum distributions. Money in a Roth IRA, you don't have to take required minimum distributions. You can leave it in there. You can leave it in there for your kids when you die and stuff and save them money. So there's another benefit to a Roth IRA. Not that I'm pitching, there's advantages and disadvantages to both. Okay, I think most people should have both types when they get there. So here's what we call, I've been calling them early distributions. This slide calls them premature distributions. They're the same. It means before you're 59 and a half. So most premature or early distributions are subject to an additional tax. Now remember, if they come from a traditional IRA, you got to pay income tax on it. But then if you make them before 59 and a half, you got to pay an additional 10% penalty. And you'll usually know that because of the distribution code, box number 7 of 1099R, if it says a 1 or 4 or a 7, the distribution is taxable. If it says 2 or 3, and okay, where are you going to learn what those codes are? Well, it's just kind of like the W-2s I told you about. If you're looking at the form and you turn it over to the back and you get out a magnifying glass, it'll tell you on the back of the form, or the 4012 has a page in there that explains those codes too. But for purposes of this slide, what we're trying to say, Here's, if it says code 2 or 3, it's not taxable. 1, 4, or 7, and we say it is taxable, but it may just be a part of it that's taxable. And this is the tax return you got to do, and I think it's scenario 7. You're going to find one of those to where not all of it is taxable. We'll go over that with you in a minute. Okay. So here's an example. Eric is 33 years old. While he was unemployed, he cashed in his 401k savings from his previous employer, which, let me stop right there. We've just gone through a year and a half of a lot of unemployment. When we start seeing tax returns this year, we may see, in fact, and I saw some last year, where they had cashed in 401ks or IRAs because they needed money to live on, right? So in this, he cashed in his 401k and he used the money to pay off debt. So when I see that, I'm trying to think in my mind, okay, there's some exceptions to the penalty. Does this qualify as one of them? So I'll leave that hanging for you. Oh, well, here it tells you in the next sentence. He does not qualify for any exception to the additional tax on early distributions, right? He received a Form 1099-R with a gross distribution in box 1 of 2,500 and a distribution code of 1 in box 7. What is the amount of additional tax? Additional tax, that's the penalty. The answer is 10% of that. Now, he's going to also have to pay regular income tax on that, but this is the additional penalty because he doesn't meet any exception. He used it to pay off debt, and that's not in that list of exceptions.
So Jim, when I was working on number 7 last night, it asked if it was due to COVID. So if it is due to COVID, is that an exception?
And right now, I've got to go look it up, but Gene's probably going to know. I'm going to tell you what I think. And right now, just because I think it doesn't mean I wouldn't go confirm it. In 2020, there was an exception. I think the first 3 months of 2021 may have an exception, but I would go into the 4012 and I'd look in the legislative extenders to see of that, or I would go research it. I might have to go look in Pub 17, or I might have to go Google it. Gene, go ahead and weigh in here. Do you remember? I know that January, February, and March had some, if you took, those are for the sick and family leave credit.
Yeah,
But if you
Jim,
took,
what she's coming up with is that she's gone into the TaxSlayer practice lab, and as she's entering the information for scenario 7, because it was a 1099-R, the TaxSlayer software asks, after you've entered all that information, was this distribution related to a COVID-related issue? Because there are some concerns. So I'm going to give a heads up to everybody in the class. If when you get to that screen, your answer should be no. We're not dealing in scenarios 7, 8, and 9 with any COVID-related issues. If you're out there in the real world doing real tax returns, we will cover under credits later today or tomorrow morning, we'll cover that issue about what to do with those credits that are COVID related and how they're worked with. But for right now, her question dealt with, she was working in scenario 7, or scenario 8, and ran across this with Simon, and didn't know what to do with it, whether to mark it yes or no. So for any time that for the sake of these advanced certification test, anything that you enter into TaxSlayer practice, if it asks you if it's COVID related, just say no.
yeah. And then in the real world, if I came across this right now, in that, I know for 2020, there was an exception. It wasn't subject to the 10% penalty if it was COVID related, but I would go look up and see if any part of 2021 covered that. I would go look in the legislative extenders. I'm not really sure.
And Jim, the other thing that we had with this, there was the 10% penalty was waived for 2020, but they also gave taxpayers the option that if they say they took out $10,000 out of their pension account, then they would have to pay the tax as that is income. But the federal government said with their COVID Relief Act that we would allow you to be taxed 1/3 of it in 2020 and 1/3 of it in 2021 and 1/3 of it in 2022. And so we will see, in my case, I would tell you, I've only seen one client who had elected to take that 1/3 for each year for 3 years. So they actually had that lowered the amount of income they were taxed on. But this year they're going to have, if they take any money out, they'll have, if they have their regular W-2 money, they're still going to have that extra 1/3 of their distribution will be counted as income. So we'll have to be aware of that. But in my case, I cannot tell you, I've only seen one case of it.
And two things I would tell you is that option of delaying it third is not available in 21. I'm sure of that. So you won't see any new ones of these, but you might ask, well, how am I going to know if they owe 1/3? And the only way you're really going to know is A, if they tell you, which they're not likely to, don't count on that. Or B, they brought their prior year tax return. And when you're looking through it, you see this form 8915E, and it's going to tell you. They're going to get a letter. I'm getting letters about this too. And so hopefully they'll bring in the letter from IRS, because they're sending letters out about, hey, you've got a taxable income coming up. But we don't really know. This is only going to be the first time we see these in the second year. But good points, Gene. What else do we want to show you about? Here's a 1099-R. Said here's the gross distribution. Okay. It says taxable amount not determined. And that's why this is blank. You're going to find that TaxSlayer right away assumes it's all taxable. Okay, unless you tell it something different. In your scenario 7, you're going to go tell it something different. But in this 1099-R, so far I don't see, well, here I do see something. I see it says a distribution code G. And okay, again, if I turn this 1099-R over and get my magnifying glass, I can see this, or I pull out my 4012 and I find that G says that it's a rollover. And there's some rules that if you take a distribution out of an IRA and you put it back into another IRA within 60 days, it's not taxable. But this here was IRA Bank. This person just took out the distribution. He told them they were going to roll it over, but they don't know that they did. That's why they say it's not here. Here's something I'm going to tell you for you personally and anybody you come across. Never, ever, if your intent is to roll it over, never, ever take the money. Have them do what's called a trustee to trustee transfer. You have this bank transfer it to the other bank or the other brokerage firm directly. And then that way you're going to get one of these things. Actually, you may never even get one, or there's a code that says direct trustee to trustee transfer. It'll say 0 up here and that box won't be checked. The thing, here's the reason why. This person, when they took this distribution and they got a check, IRA Bank was required to withhold 20%, even though it doesn't say it here, but that's their rules. The IRS rule says if you give somebody a check, you've got to withhold 20% of it. And then so this person, you know, they got a $17,500 distribution, but they only got about $14,000 in cash. If they go to roll it over in 60 days, they've got to come out of pocket with that 20% to put it back in, or otherwise they're going to get taxed on it. I know I went a little too deep into that, but that was just the reason I'm trying to give you is that usually we tell clients, just do a trustee to trustee transfer in it. So in this case, so let's go back on. Here's the TaxSlayer screen for that 1099-R. And here we just put in the boxes, right? Whether it was for the spouse or the taxpayer. what the distribution was. See, it says taxable amount is unknown. It's going to assume that it is, but look over here. There's a rollover or disability. Check here if all or part of the distribution was rolled over and enter in the rollover amount. And by the way, this is a typo. It says rolled over to another pension plan within 90 days. It's 60 days. And I'm fighting with IRS on one of our clients. She rolled it over in 60 days and the institution didn't report it. And we claimed it as such because she told us that. And I told her, I said, you may have to prove it. And IRS, sure enough, they come and said, hey, we don't have any record of this being rolled over. And she's now having to produce proof that she rolled it over into one because she didn't do a trustee to trustee transfer.
Hey, Jim,
Yes.
did you mention on that screen the where the blank box 2 is, that TaxSlayer automatically puts the same amount as box 1 in?
Yes.
Okay.
And that's what TaxSlayer is going to assume it's all taxable. So if it's not all taxable, you may have to go override that amount.
Okay.
Okay, that's good point, right? So this is where you would roll that. I told you a minute ago that they would have these distribution codes. I don't know exactly what page number this is.
Tab D, page 40 and 41, I believe.
Thank you. Tab D, 40 and 41. And so here it's going to tell you, you know, box 1, early distribution, no known exception. We told you earlier that means it's probably going to be taxable, right? But sometimes they're going to tell you here, like box 2, early distribution, exception applies. So if the trustee knows that an exception applies, which often they don't know that, right? But they might put in here box code 2, and then you're going to know it's taxable, and TaxSlayer knows that too then. In all of our codes, so here was code G, right? Direct rollover distribution and direct payment, right? You can read what that is. So let me not kind of do that. So it's fully taxable if taxpayers did not pay any portion of the cost in the plan. Okay, and so I'm going to back up right here for a second. Taxpayers did not pay any portion of the cost in the plan. What's the cost in the plan? Okay, well, generally what this means is you can find it in a couple of situations. Even maybe like in an employer plan, employers have all kinds of these products, and some of them can be annuities. They're kind of trying to do private pension plans, if you will. And sometimes they're going to say, hey, we're going to contribute so much to this plan, and you should contribute some to it. Remember, now this would be after tax money. So that means when they go to take distributions out, whatever that they've contributed to that is not taxed. And it's a complicated formula to how they do it. But that's what shows up in that box that says employer contributions. Or sometimes it's an annuity. And for those of you who don't know what an annuity is, it's money you go pay to an insurance company. It's to help act like a pension plan. And they say, okay, we're going to take all of this money, and based on your age and based on whether you decide to include your spouse or not with it, and based on your sex, we assume you're going to live to be 87 years old. And therefore, based on the amount of money you've given us, we're going to give you even payments every month of so much until you die. Whether now the insurance company has assumed you're going to die at 87. You may or may not, or you may die early. And so that's the insurance company's kind of taking the gamble. And to them, it's not really a gamble. It's a mathematical certainty. When they have enough people, you know, buying these products, they know for certain how they're going to come out statistically. But here's one of the things that's going to show up in your test exam, because it shows you in the fact pattern. It says, oh, hey, he started taking these annuity payments, I think it's back in 2018, and he elected a joint and survivor annuity, meaning when he told the insurance company, I want you to insure both me and my wife, so if I die before my wife, she keeps getting payments. that's a joint and survivor annuity. And that's one of the questions that you're going to have to ask. I'm going to show you here in a minute. But I really wanted to talk about what is the cost of the plan. That's the amount of the contributions that the employee made to the plan. So in this case, the taxpayers contributed money after tax to the cost of the plan. So only the taxable portion of the distribution is included in taxable income. And this is what we're going to find. So this is an important note that we'll find. Disability income from a retirement plan is taxed differently depending on their age. If they start getting disability before retirement age from an insurance company, this is taxed as W-2 earnings. And on the other hand, after they reach the minimum retirement age, it's taxed as a pension. Just park that in the back of your brain here for a little bit. So here we're getting where this is back. Well, I didn't mean to show this one, right? I've already shown this one here. Okay, I should have changed that. Here's the input screen that I want to wait. Okay, here we go. I'm sorry. What I'm backing up here, and we're gonna. My voice is going on here. Hang on a second. We're going to pretend here that there was some employee contributions into this plan right here. We're going to pretend, because when we get to the input screen right here, we put in 17,500. And as Gene kind of pointed out, TaxSlayer is going to assume that the whole 17,500 is taxable. But in this case, there was a box check that the taxable amount was not determined. So what we need to do here, and you're going to need to do this in this scenario 7, okay? So take note of this. You're going to click on, it says, do you need to calculate your taxable amount? Click here for options. And when you click here, and you're going to check this box, it says taxable amount not determined. It takes you to this screen. It's called the simplified method for pensions. And this is what you're going to have to do on your test tax return here. So it asks for plan cost at annuity start date. And remember, I just kind of reminded you in that scenario, it says that he started his annuity, I don't know, October of 2018, right? And in the fact pattern, it's going to tell you what the plan, or actually, if the fact pattern won't tell you, the 1099-R is going to show the employee contributions. And that's going to be what you put in here as the plan cost at the annuity start date. That was his contributions. And then it asks for starting date of the annuity. And that's told you in the fact pattern. I think it said October 1st, 2018, but I may be wrong about that. But the facts tell you, right? And then the facts tell you that, hey, you started this annuity and it was a joint and survivor annuity. So you want to check this box right here, okay? Then here comes the hard part where you're going to have to get your fingers and toes out to count it out. Because it says, if it's a joint or survivor annuity, add the ages of the recipients at the start date. So you got to go look back in the facts, and assuming I'm right about October 1st of 18, that was the annuity start date. Then you got to look on what their birth dates are, and you got to calculate, okay, on the start date of the annuity, was how old was the taxpayer and how old was the spouse? And they may or may not have turned that age by October 1st of 2018. So you got to do, it's a little mental gymnastics that you got to do, because you got to calculate, and more students make the mistake right here on this one. You have to go add up their ages. And then it says number of months paid in, well, this will say 2021, right? Now, if he started the annuity in 2018, how many months did he get it in 2021? Well, you're probably all saying to yourself, hey, yeah, you got it all year. You got it 12 months. However, if he just started getting the annuity in 2021, October 1st of 2021, we'd have to get our fingers October, November, December, January. No, oh, he only got it 3 months in 2021 if he started it in 2021. For your case, you're going to put in 12 here, but I'm telling you that distinction in case somebody walks in with one of these. And by the way, if they walk in with one of these and they say, I started an annuity and it shows that box 13 employee contributions, get some help with somebody who's got some experience with these because they get a little difficult. So, hey, what do you know? 1031, and we just got through with retirement income. So let's take a break until 1045, and then Gene's going to come back and start talking about capital gains and losses.